Most traders don't fail because the market beats them. They fail because they beat themselves first. Every blown account I've ever had wasn't the market's fault. It was mine. The market just handed me the bill, and that's what we're talking about today. Blowing accounts to consistent profits. In the previous video on 5 rules for riding big trends, I talked about how patience and timing are the backbone of a trader's edge. But today, we're diving into the part no one wants to talk about. The wreckage you have to walk through before you ever reach consistency. Now, let me ask you something. Have you ever stared at your trading account after a bad streak and thought, maybe I'm just not cut out for this? I've been there. Everyone who's lasted in this game has. You see, the market has a way of humbling you right when you think you've got it figured out. The moment you start believing you can't lose. That's when she takes it all back, and then some. That's tuition, my friend. Market tuition. You can't buy your way around it. I remember the first time I blew up. It wasn't one big trade. It was death by 1,000 cuts. Little losses I refused to cut, small wins I cashed out too early. I wasn't trading the market, I was trading my emotions. That's the hard truth. Every trader has to learn it. The chart isn't lying to you. Your hope and fear are. You want consistency. You've got to strip those 2 things out of your system like rust from old metal. Now, what do most traders do when they blow an account? They start over with the same habits. Same mistakes, same overtrading, same need to prove something to the market. And you know what happens? They get the same result. It's like watching a man try to fill a leaky bucket with more water instead of fixing the hole. Why do that? You have to stop, step back, and ask yourself, what lesson is the market trying to teach me here? When I finally got serious, I stopped thinking about trading as a way to make money. I started thinking about it as a way to not lose it. There's a big difference. Protecting capital, that's your job. Making money is just the result of doing that job well. Most people never understand that because they're too busy chasing the next big move. They forget that missing a trade never hurt anyone. But taking a bad one can wreck your confidence for weeks. I started keeping a journal back then. Not of the trades, but of my own behavior. How I felt before entering, what I saw on the chart, what made me hesitate. Because the real battle isn't on the screen. It's in your head. You can't trade price action if you don't understand your own action. And once I got that down, things started to change. Slowly, painfully, but surely. Do you remember in that earlier video when we talked about riding big trends? Those rules don't just apply when you're winning. They apply when you're losing, too. The discipline to sit still and let a trade work in your favor is the same discipline that helps you sit out when the market isn't clear. Most traders lose money because they can't stand not trading. The market's quiet, and they think they've got to do something. That's the itch that drains accounts faster than bad analysis ever could. I'd look at a chart and ask myself, is this really a high probability setup, or am I just bored? You know the answer most of the time, but the amateur presses the button anyway. That's where the difference lies. Not in the system, but in the silence between trades. You can't expect consistency in profits if you're inconsistent in your habits. Think about that. Every entry, every exit, every risk level. It all adds up to a reflection of your mindset. The chart's just a mirror. You show up undisciplined, and it'll show you loss. You show up prepared, patient, and focused. It'll reward you eventually. Not today, maybe not tomorrow, but over time, the market pays those who can wait. The best traders I ever knew weren't the smartest. They weren't the fastest. And they sure weren't the luckiest. They were the ones who could sit tight. The same principle that built fortunes in big trends also saves accounts in bad ones. Remember that connection. The same patience that helps you ride a winning trend helps you survive a losing streak. The principle doesn't change, only the direction of the market does. And here's something most traders won't admit. Consistency isn't about finding better trades. It's about becoming a better trader. You can hand 2 people the same chart pattern, same rules, same signals, and one will make money while the other blows up. Why? Because one respects risk and the other respects the thrill. One trades to win, the other trades not to lose. When you finally stop trying to prove something to the market and start trading with it, not against it, that's when things start to turn around. You stop forcing trades, you stop chasing reversals, and you start listening, because the market whispers before it shouts. The amateurs only hear the shouting. The professionals learn to hear the whispers. Now you might be wondering, how long does it take to get from blowing accounts to consistency? As long as it takes you to learn control. The moment you can walk away from a setup that doesn't fit your rules, that's progress. The moment you size smaller when you're on a losing streak, that's progress. The moment you stop caring about what other traders are doing and focus on your own execution, that's when you're beginning to act like a professional. I used to say, the big money is not in the buying or selling, but in the waiting. But that waiting isn't passive, it's active patience. The kind that's watching, studying, preparing. Every minute you spend outside the market learning your craft is one you save from losing inside it. Let me ask you this. When you open your platform tomorrow morning, will you be reacting to price or reading it? Because there's a world of difference between those two. Reaction is emotional. Reading is analytical. Reaction makes you chase candles. Reading makes you anticipate them. The first empties your account, the second fills your mind with understanding, and that's the real profit. The truth is, consistency comes from boredom. You'll know you're becoming consistent when trading feels almost dull. No excitement, no adrenaline, just steady execution of a plan you've tested 100 times. The market will still surprise you, but it won't shake you. You'll stop needing to be right and start needing to be disciplined. That's when your equity curve stops looking like a roller coaster and starts looking like a staircase. But that road, that climb, it begins with a blown account. Maybe two, maybe more. Each one teaches you something you couldn't learn from a book or a course or a quote. Each loss burns away a piece of the ego until all that's left is humility, discipline, and the quiet confidence that comes from knowing you've been through worse and learned from it. Profits follow preparation, not prediction. That one truth took me years to understand, and a few small fortunes to learn. Most traders come into this business believing their job is to predict the next move. They stare at charts like fortune tellers, drawing lines and guessing where price will go next. I did the same. I thought if I could just find the right setup, the perfect indicator, or the secret pattern, I'd finally crack the code. But markets don't reward guesswork. They reward readiness. The real money comes from preparation long before the trade ever begins. You see, prediction is about ego. It's about being right. Preparation, on the other hand, is about survival. It's about being ready to act without hesitation when the odds line up in your favor. When I started out, I'd make a forecast, take a trade, and sit there watching every tick, convinced the market would bend to my reasoning. And sometimes it did. But more often, it didn't. The problem wasn't the setup, it was my mindset. I was trying to force the market to do what I wanted instead of preparing to follow what it was already showing me. Tell me, have you ever found yourself hoping a losing trade would turn around just because you thought it should? That's prediction talking. The market doesn't care about your opinion. It doesn't even know you exist. Preparation, though, preparation makes you ready for whatever happens, not just what you want to happen. When you prepare properly, you already know your entry, your exit, your risk, and your plan for both outcomes. You stop hoping, and you start executing. I learned to spend more time out of the market than in it. Most of my real work happens when the market's closed. That's when I review charts, study patterns, analyze my mistakes, and plan the next day's plays. By the time the opening bell rings, I'm not predicting. I'm simply waiting for confirmation of what I've already prepared for. It's like a hunter setting traps. The trap doesn't chase the animal, it just waits patiently in the right spot. Preparation is the same way. Now, preparation doesn't mean cluttering your chart with indicators or memorizing news events. It means understanding structure, knowing what price has done, what it's likely to do next, and where your plan fits within that flow. When you prepare properly, you don't need to guess direction. You already know your conditions. You've defined what a valid trade looks like for you. That way, when it appears, you act, and when it doesn't, you stay still. Most traders can't do that. They confuse movement with opportunity. But not every candle is an invitation. Think back to the last time you felt you had to trade. You probably saw a small move, feared missing out, and jumped in. That's prediction again, acting on impulse instead of a plan. Preparation would have saved you. It would have told you that missing one setup isn't failure. It's just part of waiting for the right one. I used to keep a list of setups I didn't take, trades that didn't fit my criteria. Funny thing is, that list ended up saving me more money than any trade I ever took. Preparation also protects your confidence. When you rely on prediction, every wrong call chips away at your self-belief. But when you're prepared, even a losing trade doesn't shake you. Because you know you followed your plan. You know it was a good trade that just didn't work out this time. That's the difference between an amateur and a professional. The amateur measures success by results. The professional measures it by execution. I remember once during a fast-moving market, I saw prices whip up and down in seconds. The chatter was wild. Everyone was calling for a breakout, but my levels were already marked from the night before. I didn't chase. I didn't predict. I waited for my zone. Price hit it, paused, and gave confirmation. I acted. The trade worked. Not because I foresaw anything magical, but because I'd done my homework. Preparation put me in position. Patience paid the bill. You might be thinking, isn't preparation just another word for planning? Not quite. Planning is about what you intend to do. Preparation is about building the readiness to actually do it. You can plan all you like, but when emotion takes over, plans vanish. Preparation means rehearsing your discipline until it becomes instinct. You know your numbers, your process, your limits. So when the time comes, you don't hesitate or freeze. You just execute. Do you remember in that earlier talk about riding big trends, how we discussed patience being the key to letting a move develop? The same principle applies here. Preparation gives you the patience to wait for your edge. You stop trying to predict when the big move will start. You just prepare for it, so when it does, you're already in position. Traders who chase every small swing never catch the real ones. The ones who prepare quietly are the ones the market rewards loudly. And it's not just about technical readiness. It's mental. Being prepared means accepting uncertainty. It means knowing that no amount of analysis guarantees success, but proper process guarantees longevity. The more prepared you are, the less pressure you feel to force outcomes. You stop needing the market to behave because you've learned to behave yourself. That's power. That's freedom. I used to think the secret to trading was prediction. Finding that magic point where price turns. Now I know the secret is preparation. Finding that calm point where you don't. Big trends reward the same patience that prevents blow-ups. That's a truth I learned the hard way, and most traders don't realize it until they've lost enough money to start respecting time. Everyone wants the big move, the one that runs for days or weeks and makes a month's profit in a single trade. But what they forget is that the same patience needed to ride a big trend is the patience that saves you from disaster when the market's going nowhere. You can't separate the two. The mindset that keeps you steady through a trend is the same one that keeps you safe through a storm. When I first started trading, I thought success meant constant action, always being in something, always chasing movement. I believed that if I wasn't trading, I was missing out. But the truth is, the market doesn't reward movement, it rewards discipline. The big money doesn't come from being right often, it comes from being right long enough. And that kind of longevity requires patience, both in the wins and the losses. Have you ever noticed how most traders lose money, not because their analysis is wrong, but because their timing is? They enter too early, exit too soon, or can't sit through a normal pullback. That's impatience. The market teases them with noise, and they take the bait. But a trend, a true, sustained move, takes time to unfold. The ones who hold through the chop, who trust their plan and wait for confirmation, they're the ones who get paid. Patience in a big trend isn't passive. It's active awareness, watching price behavior, managing your risk, and resisting the urge to overreact. Most traders think they can't handle losses, but what really breaks them is indecision. They doubt themselves at the first sign of heat. A trader without patience is like a sailor without an anchor. The moment the wind shifts, he's adrift. You can't build consistency like that. That phrase sounds simple, but it's the hardest skill in this game. Sitting tight doesn't mean doing nothing. It means doing the right thing, which is often nothing. It means trusting your setup, trusting your stop, and letting the probabilities play out. Every tick that moves against you tests your nerves. Every small profit tempts you to cash out early. But if your analysis is sound and your risk is measured, that patience, that quiet confidence, is what lets you capture the full swing instead of scraps. Now think about what happens when patience disappears. That's when accounts blow up. Traders start forcing trades, taking setups they'd normally ignore, trying to make back what they lost. They forget that trading isn't about constant engagement. It's about selective engagement. The same control it takes to ride a winner through volatility is the same control that keeps you from touching the keyboard when the market's unclear. That's why the same patience that lets you ride big trends also prevents blow-ups. It's the same muscle, just used in different directions. Do you remember in that previous discussion about riding big trends, how I said the biggest profits come to those who can sit still when others are jumping ship? The same thing applies to losing streaks. You have to be able to sit still when others are panicking to get back in. The mindset doesn't change. Patience is still your greatest defense. When the market's choppy or your confidence is low, stepping aside is a position too. Patience pays in silence as much as it does in movement. I've seen traders ruin a good month in a single afternoon simply because they couldn't wait. They let frustration replace patience. They started trading for revenge instead of reason. But markets don't care about your frustration. They don't respond to emotion. They only reward those who can wait for alignment. When momentum, price structure, and sentiment all come together, the impatient trader tries to force alignment. The patient trader recognizes when it's already there. Patience also helps you understand context. In a trend, there are pullbacks, pauses, and traps. Without patience, those moments feel like danger. With patience, they're just noise. A trader with patience sees the bigger picture. He knows a temporary retracement doesn't mean the end of the move. He knows a few red candles don't erase the structure. That's why the patient trader catches the bulk of the move while the impatient one hops in and out, collecting crumbs and anxiety. Ask yourself this. How many times have you cut a trade early, only to watch it move in your original direction after you exited? That's the cost of impatience. Not just the missed profit, but the emotional fatigue it creates. Every time you act on impulse, you reinforce bad habits. Patience isn't just about waiting. It's about rewiring your instincts so you no longer need instant gratification. Once you learn that, your trading starts to calm down. Your decision-making becomes clearer. And let's not forget that patience isn't only about entries and exits. It's also about growth. Building consistency takes time. You can't go from blowing accounts to mastering trends overnight. Each trade, each loss, each hesitation teaches you something about yourself. The patient trader doesn't rush that process. He embraces it. He knows that skill is built in silence, not in excitement. The market has cycles, and so does every trader. There are times to attack and times to step back. Patience teaches you to tell the difference. It's what keeps you from trying to trade a sideways market like it's trending, or jumping into volatility without structure. It's what keeps your capital intact, so that when the real move finally comes, you're still in the game to take it. I remember once, during a strong bull run, I entered a position early. Price pulled back hard, but my levels were solid. I could have bailed and taken a small loss. But I waited, not out of hope, but out of discipline. I watched the structure hold, the volume shift, and slowly the move resumed. Days later, that one trade paid for every small mistake I'd made that month. It wasn't luck. It was patience doing its quiet work. Every great trend has moments that test your belief. Every great recovery from a loss requires time. That's why patience is the single thread that ties profits and protection together. The same strength it takes to sit through a winner is the same strength that tells you not to chase a loser. It's not glamorous, it's not exciting, but it's what separates the professionals from the hopefuls. The market doesn't move for those who shout the loudest. It moves for those who wait the longest. Every blown account is market tuition, not failure. That's a lesson I didn't just learn once. I paid for it over and over again until it finally sank in. Most traders think of a blown account as the end of the road. They see it as proof that they're not cut out for the markets. But the truth is, if you treat it right, a blown account is just a very expensive education. One you can't get from any book, course, or mentor. The market charges tuition in losses, and every dollar you lose has a lesson attached to it. The real mistake is not losing the money, it's failing to learn what it was trying to teach you. When I blew my first account, I didn't think of it as tuition. I thought of it as betrayal. I blamed the market, the broker, even the news. I couldn't believe that something I'd studied so hard could go so wrong so fast. But the market wasn't betraying me. It was just holding up a mirror. It showed me my own impatience, my ego, my lack of discipline. I wasn't trading a system, I was gambling with emotions. And the market, as it always does, charged me for it. Ask yourself, how many times have you taken a loss and immediately jumped into another trade just to make it back? That's not trading. That's tuition being paid twice. You're not learning, you're repeating. Every loss has value if you stop and study it. What went wrong? Was it your entry, your timing, your risk? Or was it simply that you couldn't sit still? Every blown account has fingerprints of your habits all over it. If you can read those prints, you'll start to see the pattern that needs to change. The market doesn't punish you for being wrong. It punishes you for staying wrong. I learned that after watching good trades turn into disasters because I refused to accept a small loss. I'd widen stops, add to losers, or hold overnight, hoping the market would turn around. That wasn't strategy. That was stubbornness. The moment you treat losses as failures, you start hiding from them. But when you treat them as tuition, you face them head on. You study them. You pay attention. That's when the lessons start to pay back. In this business, everyone pays to learn. Some pay with money, others with time, but no one escapes the cost. The difference is, professionals treat that cost as investment. Amateurs treat it as punishment. A professional looks at a blown account and says, "All right, what did this teach me?" An amateur says, "I'll never trade again." The professional grows, the amateur quits. The only way to fail in trading is to stop learning. When I finally understood that, everything about my trading changed. I started to journal every trade, not just the numbers, but the thoughts and emotions that came with it. I began to see that most of my losses had nothing to do with the market at all. They came from me. Impatience, greed, fear, and overconfidence. The market was neutral, I was the variable. And the tuition I'd paid was just the price of realizing that truth. I remember reading once that the market is the world's most expensive classroom. It's true. There's no diploma, no graduation, just ongoing lessons. Some lessons are cheap. A small stop, out, a missed entry. Others are expensive. An entire account wiped clean. But the price always matches the lesson. The bigger the mistake, the deeper the learning if you're willing to face it honestly. Now, when you think about it, every successful trader you've ever heard of has blown up at least once. They don't wear it as shame, they wear it as experience. It's not about avoiding losses forever. That's impossible. It's about learning how to make them smaller, how to recover faster, how to protect your capital so the next lesson costs less than the last. Because consistency isn't about never losing. It's about never losing the same way twice. You might remember in that earlier video about the 5 rules for riding big trends. We talked about patience being the key to long-term profits. Well, that same patience applies when you're recovering from a loss. The same discipline that lets you ride a big winner is the same discipline that stops you from blowing up again. The lesson repeats in different forms, but the core principle is the same. Control yourself, or the market will control you. It took me several accounts to finally realize that blowing up wasn't the end. It was a reset. Each time, I'd start again. A little wiser, a little more cautious. I reduced my position sizes, refined my entries, and learned to sit on my hands when the market was unclear. The pain of losing money fades, but the lessons stick if you let them. And after a while, I began to see those past blow-ups not as scars, but as chapters in my education. Think about it. What do most traders do after a big loss? They either quit or double down. Quitting wastes the tuition, doubling down repeats the mistake. But the few who take the time to understand what happened, who analyze every decision, they're the ones who evolve. The market is constantly testing you. Not your strategy, but your character. Each test costs something, and every blown account is a reminder that the tuition never stops. The trick is to make each lesson cheaper than the last. Risk less, wait more, and trade only when the setup is undeniable. Once you see losses as part of the process, they stop scaring you. You start managing them instead of avoiding them. The market stops being an enemy and becomes a teacher. Harsh, unforgiving, but fair. I used to look at my old account statements, the ones that ended in zeros, and feel embarrassed. Now I look at them and see progress. Each one marks a turning point, a stage of growth. Because the truth is, you can't learn the emotional strength required for trading by winning. You only learn it through losing and surviving. Every blown account teaches you something about what kind of trader you are and what kind of trader you need to become. So when you think about failure, remember that in trading, there's no such thing as a total loss unless you walk away without the lesson. Every dollar lost can come back with interest if it buys you experience, patience, and perspective. That's why every blown account is market tuition. A payment toward the trader you're becoming, not a penalty for the one you used to be. True discipline is knowing when not to trade. It sounds simple, but it's one of the hardest truths a trader ever has to accept. Everyone comes into this game thinking success is about finding opportunities, spotting setups, being active. But the real mastery, the kind that separates the survivors from the casualties, lies in restraint. It's not about how many trades you take, it's about how many bad ones you avoid. Most traders blow their accounts, not because they can't find a winning setup, but because they can't sit still when there isn't one. I learned that lesson through pain, the way most lessons in the market are learned. In my early days, I believed activity meant progress. I wanted to be in the market every day, catching every move, proving to myself that I could outsmart the noise. But the market doesn't reward motion, it rewards precision. I'd trade out of boredom, out of frustration, out of fear that I might be missing something, and every time I did, the market made me pay for it. The charts were the same, the tools were the same. The only thing that changed was my patience, or lack of it. Tell me, have you ever opened your platform, stared at a flat chart, and thought, there's nothing here, only to start forcing a trade anyway just to feel busy? That's the moment discipline breaks. Trading isn't about participation, it's about waiting for alignment. You have to understand that doing nothing is still doing something. Sitting on your hands is a position, a powerful one. The traders who survive the longest are the ones who know when to keep their powder dry. True discipline means being comfortable with silence. The market spends more time in noise than in clarity, and your job is to tell the difference. When you're disciplined, you don't chase. You let the market come to you. You know your setups, your levels, your confirmations, and until they appear, you stay still. Most traders don't have the patience for that. They see every candle as an invitation, every tick as a signal. But the market doesn't work on your schedule. You either wait for your edge, or you trade without one. And trading without an edge is just gambling with a nicer interface. In those early years, I used to think my discipline was about cutting losses or managing risk. But those are just surface habits. The deeper discipline is psychological. It's the ability to control your own impulses, To say no to your own excitement, no to your own fear, no to the illusion that you can make the market move just by participating in it. I had to train myself to recognize that no, trade days are part of the plan. If you can sit through a quiet day without needing to make something happen, you're already ahead of most traders. Discipline isn't built in the winning streaks. It's built in the waiting. It's forged in the moments when the market tempts you with almost setups, when everything looks close to lining up, but not quite there. That's where amateurs jump in. That's where professionals hold back. The difference between those two decisions defines your equity curve over time. One is fueled by impulse, the other by patience. I used to remind myself every bad trade starts with a small compromise. Maybe the candle wasn't fully closed. Maybe the volume wasn't right. Maybe the trend line wasn't confirmed. You tell yourself it's close enough. You press the button. And in that moment, you've traded discipline for dopamine. The trade might even win, but the real damage is psychological.